Welcome to Call Options for Newbies Part 3, Finding and Trading Calls. If you have not watched Call Option for Newbies Part 1 and 2, please go watch them now because we will be assuming that you know the information in the prior two videos. This presentation is copyrighted, but you can publish it and its contents as long as optionsanalysis.com is shown at the source. Presentation is not a recommendation or advice to buy and sell any of the stocks and strategies in the presentation. This is an educational video to teach you about trading call options. The results may vary and there is risk in trading stocks and options on stocks, and there are no guarantees. All the charts and analysis that you're going to see in this presentation are coming from optionsanalysis.com. Google Options Analysis to find us, and you'll land on the login page shown here. This is where you can log in. This is when you can sign up and subscribe and watch other videos that we have available. We're now going to discuss how to trade a call option, how to choose a stock, how to look at technical analysis, how to decide on an expiration date, and how to exit a call option or possibly adjust it. As we discussed previously, bid-ask spreads can vary widely inside different call chains for different call options. The top example is Citigroup, a bank with a lot of volume and open interest and very tight bid-ask spreads. Penny differences between the bid and the ask in some of these at-the-money call options. Below is an example of another stock, also a bank, Bank of Hawaii. In this case, very low volume and very low open interest and extremely large bid-ask spreads for almost the same strike price. Here's a strike price of 40 with an ask of 6.2 and a bid of 1.5. Here's Citigroup for a strike of 40 with a 0.6 and a 0.58 bid and ask price. So they can vary widely. Their IVs can be significantly different, and the bid and asks can be extreme. We have a tool to help you find stocks with small or low bid-ask spreads. That tool is called the slippage tool, available at the top of our navigation bar. You take a stock list, apply the slippage tool to it, and it will rank the output in different ways. One of the ways it can rank it is by the slippage equation, 100 times the ask minus the bid divided by the close price, expressing it as a percentage. The lower the percentage, the less of a spread percentage you have to give to the seller of the option when you buy it. I ran the slippage tool against a well-known list of stocks and ranked them, and stock symbols you've heard before and we know are being very actively traded are shown at the top. Apple number 1, Google number 2, Amazon, Priceline, and Baidu, all there with low slippage, optionable call options. When you buy the call option, who is selling you the call option? What you need to understand is usually it's a market maker selling you the call option. Options simply do not have the kind of market that stocks do. There's so many of them for even just one stock that a market maker is needed to be able to gather all the available information of who is trying to buy and sell options in different strikes and different expirations and put them together. A market maker makes his profit on the bid-ask spread. If he does not have a lot of action, he has to open the spread to make his money. If there's a lot of action, in the option series, he can significantly reduce it and still make a profit. There are 6 exchanges that have market makers. You'll see these when you go to your broker. Some brokers allow you to work directly with an exchange. Others give you the option to turn on Smart Exchange, which finds the best bid-ask spread coming from the different market makers. That's usually how you will trade. You will let the broker handle the routing to the market maker with the best bid-ask spread. Just so you'll know, if you're a very large volume trader, you can trade directly with individual market makers using something called level 2 quotes. Market maker has different kinds of strategies he can use that allows him to take the bid of one option and make it tradable with the ask of a different option. You may hear of these things called box trades, put the call parity, long and short stocks. A market maker is constantly hedging his position so that the delta is neutral. That is, delta that we discussed in the second video, when you put all the legs together, is close to 0. When you trade, you would like low slippage, and you would also like low IV, the implied volatility inherent in your option quote. One way to tell whether your quote is high or low is to look at the past history of the implied volatility in your stock and see where you stand in the current range. Optionsanalysis.com has that feature, especially when you chart the IV chart, which is shown at the bottom of the risk graph. And inside the box on the upper left side of the IV chart, there's percentages showing where you are in the 1-year range. I went out and found an extreme example of a ETF that's currently at the very bottom of its 1-year range, and that's IYR, the iShares Real Estate ETF. Here's its latest values down over here, and here's where it came from. The housing market had a lot of volatility over the last 1 or 2 years, but has significantly settled down lately and is currently quite bullish. Another feature you'll discover: when something becomes very bullish, its volatility decreases, its implied volatility decreases quite dramatically, and option quotes get cheaper. That's because there's no fear in the stock. Implied volatility usually rises when the put option quotes start to rise as more and more traders start to trade put options to protect themselves against what they perceive as future volatility that could happen. Stock selections, recommendations. You need to find a symbol to trade. One way to do so is by looking at other websites to see what stock symbols they might be recommending. Stocks that other guys or other traders think might be going bullish. Here's a few, and there are many you can choose from. Seeking Alpha is a very popular website filled with investment ideas from various traders and bloggers. iBankCoin.com has a trader known as The Fly. He'll show you his daily trades, what he's trading, and he has a very good track record over many years of trading. There's also Mad Money with Jim Cramer on CNBC. He daily shows you stocks that he's recommending. On our website, once you have a list of stock symbols you might want to trade a call option in, you can use our Edit List tool to populate any one of 20 lists with stock symbols that you'll be able to copy and paste into the page and save into the list and transport all over our website looking for call options. On our website, you can create and save a virtual call option trade. Virtual trade means that the trade only exists on paper. No money has changed hands. A real trade is the trade you're going to do with your broker. You can save your real trade that you make with your broker in optionsanalysis.com as a virtual online trade on our website. There are at least 4 different tools you can use to create a trade, and I'm going to go over each one of them. The first is at the top in our navigation bar. You can locate under Manage Trades, Create Trade. A simple tool to create the legs in your trade you're looking for. You can go into our option chain, and on the left side under Num, put how many contracts you'd like to trade, and click Edit or one of the risk graph buttons. I'm going to show you very quickly 2 of our technical indicator call option searching functions, one based on moving averages and one based on pattern matching. Here is Create Trade. We're going to create a November 16th 41 strike call option in HOG, which is the stock symbol for Harley Davidson, the motorcycle maker. If you're going to create this trade in the past, on the upper right of our website is a date box. You can click on the little calendar symbol and move the date to the date where this trade was first done with a broker, or the date you would like to create a trade on. Then click Go. The website will move back to that date and time and behaves just like that date was the latest date. All the data and options and stocks that were available that day will be online. Now, we only keep stocks that are actively trading. So if a stock no longer trades post this date, it's gone entirely from the website, even in the past. To create the trade, you have 6 legs that you could start with. But you're not restricted to just 6 legs. You can have as many legs as you want, but you start with an initial 6 legs. You select your trade date, which will typically be the date of the website. If you want to buy or sell, how many contracts, select your expiration, indicate you want to be a call option, type in your strike price. If you already know what your quote is and you got from the broker, use open at and type the quote in. Otherwise, use mid quote, assuming you've made that selection inside your general settings part of optionsanalysis.com. You can color this leg by clicking Set under leg color and selecting an appropriate color you'd like to use. Leave the trade name blank. You'll get auto naming. Select a folder you want to put this trade in once it gets saved, and click the Save button. When you buy the call option, it has the risk graph shown here on the left-hand side. And it will look like this inside your risk graph. You will have bought one HOG, November 12, 41 call. Your entry price is 3.65. It's got a tight bid-ask spread. This is its IV, the volume, the open interest, and how many days are left. The person who sold you this call option ended up with a sell call risk graph. I've overlaid the sell call risk graph on the right hand side of the bottom graph, just to give you an idea of what risks the sell call trader is taking when he sells you your buy call. The sell call trader makes money if the stock goes down. His profit zone is limited to how much he sold you the call for. So he's very much interested in selling you the call for the most money he can. If the stock goes up, and he did it as a naked sell call, which they almost never do, he has the possibility of unlimited losses. He's required to have margin if it's a naked sell call, and as the stock moves, if the stock were to move against him, he's required to put up more and more margin to cover his possible future losses. Typically, however, when somebody sells you a call option, some other leg is used to eliminate the unlimited losses that can happen, such as buying stock to offset the naked sell call. That position where you've sold a call and own stock is sometimes called a covered call, which is the subject of an entirely other video presentation. So, now that we know how to create a call trade, analyze it, what are some other ideas for deciding on which stock symbols we should go trade inside options analysis without going to other recommendation sites? We have a number of technical indicators located under our stock tools. One of the most popular ones used by most everybody is what's called the moving average bullish crossover indicator. A moving average is you sum the stock close prices over a series of days to get one number. You can have what's called a short moving average and a long moving average. The short moving average uses fewer days than the long moving average. When the short moving average crosses above the long moving average, that's an indication the stock is going up, and you would go bullish. You would buy a call option. When the short moving average crosses below the long moving average, you would go bearish. Or if you bought a call option in the past, then this would be the time where you would sell your call option and close the trade. On our charts inside optionsanalysis.com, almost all the charts have the ability for you to display the moving averages. The chart below shows a purple line of a short moving average of 10 days and a brown line showing the long moving average of 30 days. 10 days and 30 days are two well-known moving average values. Whenever the short moved above the long on this chart, you see a B symbol. There's one here, and there's one here, and that was when we would go bullish. When the short moved below the long, we would sell. So in the stock here for Coca-Cola, we had a nice bullish uptrend that occurred and was captured by the moving average, and we got out here. Then we got in here and captured another uptrend and got out here. The S with a circle in it stands for a split that happened in Coca-Cola on that date. The stock shares were split 2-to-1. Your call option has to be altered when there's a stock split. We won't go into it here, but consult with your broker if you encounter a stock split while trading your call option. Depending on how it's split, either your underlying changed from 100 shares to a different number, or you were given more calls at a different strike price. Moving average backtest calls. We have a tool where you can search directly for call option trades that have been optimized to buy on a moving average crossover bullish and sell on a moving average crossover bearish, to investigate all of the crossings over a 3-year period, then to output the list of stocks that you're searching in terms of their moving average back-tested performance. In addition, it provides you with all the information you need to decide as to whether or not you might want to trade the call option. Here's an example of some output. This column shows the stock. MA and dark are two links you can click which will immediately pop up a chart showing the moving average chart for this stock, showing you what has happened in the recent past and what's happening right now. Dark shows darknet, which we'll discuss next. Then there's stock name and its sector. The sector is the type of stock this is. For example, electronic components for APH, drugs for Johnson & Johnson, and motorcycle bicycles for Harley Davidson. Then this is the list of calls that it might want to trade. This is the slippage that's occurring in that specific call only. The volatility of that particular call option was computed, the implied volatility, and it was compared against the 1-year history of the stock's implied volatility, and it's ranked by where is the current implied volatility inside that 1-year past history. And right now, many call options are at a 1-year low. Volatility has significantly dropped in the implied volatility arena. This is showing the latest close. This is showing over the last 3 years of trading moving averages, what happened to profits, rate of return, the number of trades, and the wins and losses. The moving average backtest searcher has been optimized. We've detected which are the best long and short days to trade call options. It's been optimized as to what should be the best expiration time period. It's been optimized to find the best strike to trade the call option in to get the best rate of return. The numbers are, you should trade the call option at least 30 days in the future, but just after 30 days in the future and not that much longer. Typically, you're probably going to get a crossover using the optimized long and short days that this thing is using before 30 days are gone by. There's no reason to go further and spend money to buy the call option. In higher days, you have to pay more for the quotes to get more expiration time. The best strike is to be about 5% or more in the money. Just under 5% would work best. You want to get a little in the money so that you have some intrinsic value in the trade. You end up with a delta of around 60 to 70 when you're trading 5% or more in the money with your call option. So using that criteria, it finds the calls and the stocks that match the criteria and put them under trade leg. And you can click them and go right into the risk graph and see if you'd like to trade that. We have a presentation going to significantly more detail in using the moving average call option searcher and showing you the different features of it and how the numbers were obtained. Another technical indicator we have online, which is unique to our website, is an investigation into using pattern matching to try to find bullish and bearish conditions. Our particular pattern matching technology we call darknet is using channels to find different kinds of channel patterns. Just like in moving averages, we use channels over short time periods and long time periods and look and see how these channels cross over each other to decide whether we should go bullish or bearish. Very, very similar concept to the moving averages concept. A channel in a stock is a best line curve fit to the close prices over a specific set of days. For example, this pink channel, this middle line, was the best line curve fit to all the close prices that occurred inside this pink channel. And that line is then drawn as a straight line. And you see there are as many guys above and below the pink line in sort of an equal number. Then from the pink line, you equally move out until you encompass all the close prices that occurred over that time period. That becomes the channel boundaries. Sometimes when the channels are shorter, the boundaries can be quite small, shown by the blue line here, and then the boundaries for a mid-range set of days is shown in the middle. These things are moving around all over the place and form all kind of patterns, and you can create a pattern matcher, which when all of a sudden the pattern shows up that's been detected in the past to indicate bearishness or bullishness, that gives you a buy and sell signal. For example, here's a pattern that generated a bearish signal, and that's what happened after the bearish signal got generated. The stock went bearish and in fact stayed inside the bearish channel that had been created by the pattern matching technology, more or less. So, using pattern matching, we've created a call option searcher for buys and sells inside the pattern. If you go to our Darknet page and click on Darknet calls, you'll arrive at the top page. You put in your stock list you'd like to search over or your individual symbol you'd like to search over, and you simply click search. If your stock currently has a buy without a future sell signal, you'll get an output. In this case for hog, we got an output to trade the November 12 41 strike in hog, has a buy signal that's coming out of Darknet channels. Also want to point out, in the prior presentation, prior file, for moving averages, hog was also bullish coming out of the moving averages indicator. Finding a stock symbol that's bullish in both indicators tends to be a good sign. If you're in our Darknet subscription to options analysis, as you create and save trades, those trades appear in folders. When you log into our home page, it picks your default folder, finds all the stock symbols you have inside of it, and puts out a color-coded latest day save trade performance table. An example is shown at the bottom. Green means that if you're bullish, things are going well. Yellow means that it's neutral, and orange down to red means that it has gone negative. Very good color code indication of what's happening on a day-to-day basis to the stocks in your folder. We're now going to look at the things you can do to your call option to end it. Before expiration, you can close the call option trade by simply selling it. Now it turned out that hog, as shown after earnings in this stock chart on the left-hand side, reported very good earnings after a buy signal occurred in Darknet, and we started trading hog. That very good earnings caused a pop in the stock to happen and profits to occur inside our call option. So on this date when earnings were good for hog and we're currently sitting on a lot of profits, you might consider selling. If you want to sell, inside optionsanalysis.com, you edit your hog trade and select exactly the same trade amongst the legs that you can add to the hog trade in the edit trade page, except that under position, instead of selecting buy, you select sell. And under entry, you allow the website to grab the latest bid acts that are occurring on the date that you're sold, which happens to be October 23rd after buying on October 17th. The difference between your entry price and your sell price is your profits. You also would go to your broker and do the very same thing and sell the exact trade that you bought and collect your profits, and the trade is gone from your broker's website. Inside options analysis, the trade isn't gone. It will exist with these two legs inside of it, and it'll risk graph as strictly a cash position only and will no longer show any risks. You are done after you've sold the call option and the trade has ended. Those are not your only options. If you think there might be still further price action in the stock that you're trading, but you'd like to reduce your risks, and in fact possibly turn the trade into a no-risk trade with still upside potential, there are many things you can do, and I'm just going to show one. One of the things you can do is to buy a put option in your stock to go with your call option. You edit the trade, you add a leg that's a put option. In this particular case, we added a 47 strike put option to our call option hog trade on October 23rd, added it to the call leg, and risk graphed it. And when we did, we got the bottom chart. The trade has turned into a no-risk trade. If the stock were to go up, we'd lose money in the put, but we'd make considerably more in the call option, and we can participate in additional upward movements in our stock hog. But if hog goes down from this point forward, our put starts to make profits, counteracting the losses that are occurring in our call option. And if it goes down far enough, we can start making more money inside of our put than inside of our call. We've paid a price to get this no-risk option trade, and that if hog suddenly decides to start moving sideways, then time value takes over, and we start losing time value in both our put trade and our call trade. However, the most we can lose is around $160, and we have a minimum profit in the trade of $107 that we'll always be able to get our hands on. We can always exit the trade early. After doing a put adjustment to your call option trade, you still will have to get out of the call option at some point before it expires or at expiration date. In addition, you'll also have to get out of the put option. We haven't discussed the put option, that'll be the subject of another video. But you would have to exit both these trades still sometime before expiration or experience the consequences of assignment. Assignment is what happens when expiration occurs. You have not done anything to your call option, and the call is in the money by even a penny. You will be assigned 100 shares of the stock that you have a call option in at the strike price that you had when you made the call. Here are the events that will happen. You will have a leg where you have bought 100 shares, in this case hog, at a price of 41. Now, if it happened to have been assigned on the particular date of October 23rd, which it will not, although you can ask for it to be assigned, you can indicate to your broker that you would like to exercise your call option on October 23rd and obtain your stock shares. I'll show you why you don't want to do that. But if you did, this is what would happen. You would obtain the 100 shares at a price of 41. However, you would lose all of your call option entry price, because you would also have to sell your 41 call option at zero. If you wait till expiration and you're only slightly in the money, these are the things that will happen to you, and this is how you will compute your profit. So although your stock shares have a profit of $589, the 365 that you use to purchase the call option is being deducted from your overall profits to give you a profit of $224. If you go through assignment and these events happen to you, you will no longer have the call option trade. It will have been closed by selling it away at the price of zero, and you will have converted your call option into its underlying stock trade, and your stock trade will continue as an indefinite trade post-expiration. So you can wait for your call option to expire and be assigned. You can sell it or you can adjust it. But if you adjust it, you'll still have to close your call option at some point. Here's a summary of all the things that we discussed. We started with what was a call option. We indicated that it involves strikes and expirations. And we looked at the bid ask and the chain. We then got into volatility. We discussed Black-Scholes and implied volatility that's inherent inside the quotes. We showed IV smiles, IV skews. We went into slippage and Greeks and the effect of dividends. We looked at finding stocks that you might want to trade a call option in. You must be bullish on the stock. We showed how to create an option trade, how to save it, how to risk graph it. We discussed how market makers are selling you the call options that you're trying to buy. We looked into closing the trade by simply selling it back or getting it assigned or adjusting the trade. Thank you for watching our call option for newbies videos. Please try our website, optionsanalysis.com. Try to investigate the different things I've shown you by going on the website and trying to duplicate some of the things that you saw happen in each of these 3 videos. Thanks for watching.